Hey everyone, welcome back to the channel. If you're new here, I'm Qatar, a Canadian realtor who helps people like you understand the home buying process without all the confusing lingo. Today, we're diving into a big one, mortgages. What kinds there are, how they work, what to watch out for, and how to figure out which one fits your life best. So grab a coffee, get comfy, and let's break this down. Let's start from square one. What is a mortgage? A mortgage is basically a big loan from a bank or lender to help you buy a house. Unless you're walking around, say, with $700,000 in cash, chances are you'll need one. You agree to borrow the money, pay interest on it, and here's the important part. You give the bank the right to take back the house if you stop paying. That's called a foreclosure. Don't stress though, we'll talk about how to avoid this later. Mortgage usually lasts 25 to 30 years, but you don't sign the whole thing at once. You renew every few years, and that chunk of time is called a term. We'll get into that soon. Now, let's talk about one of the most confusing but super important decisions, fixed rate versus variable rate. Sounds simple, right? One's fixed, one changes, but the impact on your wallet, that's huge. So, let's talk about the fixed rate mortgage. With a fixed rate mortgage, your interest rates and mortgage payments stay the same for the full term, whether it's 2, 5, or 10. You lock in the rate and that's what you pay. No surprises. So if the Bank of Canada hikes rates tomorrow, your payments still the same. That kind of stability is golden if you're kind of like on a tight budget, you like predictability, or you just don't want surprises. It's like putting a mortgage in a cruise control. Now, the flip side, if the rates go down, you're stuck with higher rate. You need to break the mortgage to change that. And trust me, that comes with hefty penalties. So yeah, you get peace of mind, but you might pay a premium for it. With variable rate mortgage, this one moves with lenders' prime rates, which rises and falls based on the Bank of Canada. If interest rates drop, your interest goes down. So basically, you pay less interest, and if they go up, you pay more. But here's where it gets interesting, where there's two kinds of variable mortgages in Canada. First one is called an adjustable rate mortgage, where your monthly payment changes along with the rate. So if the rate goes up, you pay more. If it goes down, you save. Then there's the fixed payment variable mortgage. This one keeps your monthly payment the same, but what changes is how much it goes towards the principal and interest. So if the rate rises, more of your payment goes towards the interest. If they drop, you pay off the loan faster. But there's a heads up. If rates rise too much, like they did recently, you could hit something called as a trigger point, where your entire payment just covers the interest. At that point, the lender requires you to increase your payments. So now you may ask which one's better. Honestly, it depends. Go with fixed if you need stability for your monthly budget, you're a low risk kind of guy or gal, and if you think rates are going to go up. And with variable, if you're comfortable with some risk, you think rates might hold on or drop, and you might sell or refinance soon. Just a quick side note, historically, variable rates have costed less in Canada, but with today's market, it's not always the safest bet. So look at your lifestyle, look at your income and your risk tolerance. Now, let's talk about another one, that's open versus closed mortgage. And no, this has nothing to do with doors. I know that's a silly joke. Open mortgage, you can pay it off early, no penalties. You know, if it's great if you're planning to move or expecting a lump sum soon, but you'll have to pay a higher interest. Closed mortgage, on the other hand, you get a lower rate, but if you want out early, there's penalties. Most people choose closed because they plan to stay put for a while. So think about your future planning to move, then maybe open is better. Sticking around, then close would save you money. Now, you must have also heard about something called as a conventional mortgage or a high ratio mortgage. Now, conventional means you've got at least 20% down and then no mortgage insurance is needed, which is great. So let's say if you have a house that is worth $500,000 and you put 100,000 down, then you get a conventional mortgage. At the same time, a high ratio mortgage means less than 20% down. So in this case, again, if it's a $500,000 house, and let's say you only have 90,000 or even 95,000, it still is now considered as a high ratio mortgage because it's not a full 20%. What you need to do is you'll need CMHC insurance, which will protect the lender, not you. That insurance is not cheap. That's around 2.8% to 4% of your loan. And it's usually added to your mortgage. So, yeah, you're paying interest on that too. But it does help people buy sooner. In fact, that's how I got my first place. Now, let's clear up the two terms people mix up all the time, and that's amortization and term. This is something we spoke in the beginning. Think of amortization as the full timeline of your mortgage, usually 25 years, sometimes even 30. That's how long it takes to completely pay it off if you make regular payments. Longer amortization means lower monthly payments, but more interest over time. Shorter amortization means higher payments, but less interest over time. Now let's talk about the term. That's usually the length of your current mortgage agreement, usually 1 to 5. Most Canadians go with 5. When your term ends, you renew your mortgage. It isn't done. You've kind of like just finished a chapter. So, to give an example, amortization is like a whole book, and term is just one chapter. Now, you'll also hear there's some other kind of mortgages that come into mind. And number one is a cashback mortgage. Um, you'll get like a little cashback, 1 to 5% when the deal closes. Helpful for moving costs of furniture, but they usually have a higher interest rate. And you if you break early, then there's penalties. Then there's the hybrid or the combo mortgage, which is kind of like fixed part variable, gives you a mix of security and saving potential. It's kind of like very niche. Then there's the reverse mortgage, which is quite applicable to 55 plus. So if you're 55 plus and you can borrow against your home equity, no payments are required. The loan is repaid when you sell or pass away. It's helpful for some, but definitely it's kind of like the last resort. And then there's the HELOC, which is a short for home equity line of credit. Now, it's not technically a mortgage, but it works like one. So you borrow against your home equity. Only pay interest on what you use. It's great for flexibility, but rates are variable and can rise. Now, before you even look at homes, get pre approved first. Why? Because it tells you how much a lender will actually give you and it keeps your house hunt realistic. Lenders will look at a few things. For example, your credit score, your income and job stability, your debt levels, your down payment, and yes, you'll have to pass the stress test. Even if the rate is at 5%, they'll test you as if it's 7 or 8 or whatever. It's there to protect you from future rate hikes. That's the logic behind it. So let's talk about penalties and portability. This usually gets in the fine print, and because this stuff is very important, it can cost you a lot. What are penalties? Like if you break your mortgage early, you'll pay. For fixed rates, that could be thousands thanks to something called as the interest rate differential. Uh, when it comes to prepayment privileges, most lenders let you make extra payments like 15% lump sum per year or increase your monthly payment. This is huge if you want to pay down for a mortgage faster. Then there's something called as the portability. If you're moving, some mortgages are portable, meaning you can bring your existing rate and terms to your next home. And that can save you big if the rates have gone up. Okay, that was a lot. We covered a lot today, and here's the big takeaway. Don't just focus on the interest rates. Look at many things. You need to look at many things like the term, the flexibility, your life plans and talk to a mortgage broker. Ask all these questions and always know your options before you sign anything. If this video helped, give it a thumbs up, hit that subscribe button, and drop your questions in the comment. I'll reply to everyone. And then again, I'm Qatar, helping you demystify real estate one video at a time. See you next week.